program this evening is going to talk about how to protect our assets, protect our assets, and so we don't have to share them with some of our governmental friends. Philip Drudy is with Small & Lupin and Company. He's a licensed certified public accountant in New York. He's been practicing public accounting for over 30 years. He represents clients in transportation, real estate, and professional service industries. He's a frequent lecturer at seminars and conferences across the country on tax, estate planning, business life cycle issues. Also joining me on the panel is the senior managing member of Ehrlich, Petriello, Gooden & Plaza, a prominent law firm in Newark, New Jersey, Alan Ehrlich. He counsels clients regularly in tax planning strategies. He represents many of you here, I know, on estate planning, probate matters, sales and purchases of businesses. He handles family law issues, shareholder and partnership agreements, and tax controversies. Mr. Ehrlich's practice includes wills, credit shelter trusts, bypass trusts, powers of attorneys, living wills, irrevocable life insurance trusts, and a lot of other things I can't even pronounce, which he'll tell you all about. He has extensive experience handling tax controversies before the Internal Revenue Service, New Jersey Division of Taxation, New York Tax Department. He handles representations at audit levels, and deals with abatement of penalties and interests. So the program this evening, and we welcome your questions as the program progresses. We're going to be speaking with you today about your assets, dealing with your assets when you're not around, dealing with your assets while you're still here in terms of maybe putting them into a certain type of trust, family limited partnership, whether you own your property individually, in a corporate entity, a limited liability company, LLC, an LLP, limited liability partnership, an LP, a limited partnership, a family limited partnership. There's a lot of ownership structures that you haven't thought of. There's a lot of ownership structures that you haven't considered, but that you need to consider, because the way you own your properties now might not be the best form of ownership for you when you're gone, or your family when you're no longer here. So we're going to talk about your will. We're going to talk about trusts. We're going to talk about valuations of your property, different methodologies of valuations, because ultimately it's all about being able to pass on a larger percentage of your holdings so that you don't have to bear, or your successors don't have to bear, some of the tax consequences that may be involved. So, I'd like to invite up first, who's going to be our first speaker this evening? Mr. Ehrlich, to begin the presentation.
Thank you, Bruce. Thank you, everyone, for coming. We're talking about estate planning, wills. It can be kind of sort of a downer type of an issue to deal with. So Bruce had suggested to me this afternoon maybe I should start off by lightening the mood. So I said, that's no problem, because I have this friend Dan, who was going to inherit a fortune from his father, who was very sick. And Dan wanted to be able to enjoy what he was going to get from his father with someone very special. He was not married. So one evening he went to a singles bar, and lo and behold, he met up with the most beautiful woman he ever saw. And he said, I may look like just an ordinary man, but I'm going to inherit $20 million when my father dies very shortly. The woman was naturally impressed and went home with him that night. 3 days later, she became his stepmother. When it comes to estate planning, women are much smarter than men.
That covers a lot of different things. Come on.
So anyway, that's my friend Dan. His father was naturally in the real estate business. So I want to start off and quickly breeze through a few things, some of which you may know, maybe not. The importance of a will. I don't have to sit here and tell you why a will is important, but I'm going to illustrate a few things, and I want to use an example. So let's say I have a $10 million estate. I value all my assets, my money, and I pass away. I leave everything to my wife, very nice. So now she has $10 million. She passes away, leave it to the kids, they have $10 million. What are the tax consequences of that sort of a scenario? A rather typical scenario, perhaps. Well, when I pass away and leave $10 million to my wife, there's no tax, no estate tax. Why? Marital deduction. No matter how, by and large, no matter how much you have, if you're leaving it to a spouse, there's no estate tax. So one would think you don't need too much planning on that account. However, your spouse dies, leaves it to the children, that's when the tax comes. So much of the planning that goes into estate planning is preventing the estate tax from occurring on the second death. If you're not married, it's going to get you on the first death. And so a will is important not just for the obvious reasons, but it's important in order to establish one or more trusts in the will, which can take some of the assets that you pass away with, and instead of giving them outright to your spouse, it will go in trust for your spouse. And if you do it in a certain manner, we'll talk about it a little later, those assets that are in trust for your spouse will not be estate taxed when she passes away. It could be a very valuable tool. But we'll get to that. So the will is not just about naming executors and guardians and things like that. Tax planning starts in the will. A living will. A living will is not a will. A living will is generally a one-page piece of paper that says that you don't want any extraordinary life-sustaining treatment. In addition to a living will, many people consider healthcare powers. Healthcare powers is essentially a power of attorney where you give to someone else the ability to conduct or control your medical care if you can't. If you can, then it doesn't activate. That's a healthcare power. General powers of attorney. If you're unable to conduct your day-to-day business, you may want a general power of attorney given to your spouse or someone else or a business associate so that your day-to-day business can be conducted without interruption. Let's talk about probate. We've all heard that we want to avoid probate. So the question would be, well, why are we trying to avoid probate? The stigma seems to be, well, it's going to cost some kind of extra money, maybe there's tax, they'll tie up my money and this and that. Now, most of those things are not true. Probate is merely taking your will into the surrogate's office and having them review it, say the will is good, validate the will, and appoint the executor. An executor has to be appointed, otherwise you can't conduct business, in the estate. So there's no tax on probate. It's a couple of hour process. and it's generally not anything to avoid. There is something called an ancillary probate. If perhaps you own a house in Florida, or out in the Hamptons, or down the shore, well, not down the shore, but if you own another property out of state, that property will have to be separately probated, calling it an ancillary probate in that state in order to clear title. So there you can avoid probate if you don't want to have to hire a lawyer or get involved in Florida. You can put that property or the house, whatever you have down there, into a living trust, the basic classic living trust. There's no particular estate tax benefit to it. There could be, but generally speaking, it's just a methodology to avoid the probate process and the couple of $1,000s that might be expended in the probate effort. Estate tax. There's a federal estate tax, New Jersey estate tax, and a New Jersey inheritance tax. What?
Governor Christie's tax.
A Governor Christie tax. Well, that's coming, I'm sure. So, many of you may know, the federal estate tax will be levied on assets exceeding $5.45 million. So, the federal government has sought to ease the estate tax burden on the citizens. New Jersey has these two estate type taxes. One is the estate tax. The estate tax in New Jersey, you will be taxed on assets in excess of $675,000. That's a pretty low bar. Keeping in mind, anything you leave to your spouse won't be taxed. It's the second death. It's when it's going to the kids or other family members. That's when the tax comes in all around. And in addition to the New Jersey estate tax, those assets over $675,000 will be taxed. There is a New Jersey inheritance tax. An inheritance tax is a tax levied on the recipients of the bequest, be it a will bequest, or if you don't have a will, you get it under intestacy. But there, if it's a direct family member or a lineal descendant, children, spouse, grandchild, no inheritance tax. Doesn't matter. If it's brothers, sisters, nieces, nephews, you're looking at a 15% range inheritance tax in New Jersey. What's included in your taxable estate? Well, whatever you have in the bank and in your brokerage accounts, even when the accounts are held jointly, it's going to be in your estate for the most part. Life insurance, if you have life insurance that pays to your spouse or kids, that's going to be part of your taxable estate. It may or may not create an estate tax, but it's going to add in, obviously, your home, your retirement accounts, your IRAs, all gets added in, no breaks, no exemptions. If you hold joint accounts or joint stock accounts, they're going in, that's all included in your taxable estate. As a rule, and maybe Phil can bear this out, jointly held assets, typically jointly with your wife or kids, it's generally not good estate planning. Because by doing that, all you're doing is transferring the asset to your spouse, and it's going to end up in her estate. Now, if it's not too much money, it really doesn't matter. But any major asset, I'd be careful about making it joint. You're not getting around any estate taxes by doing it, that's for sure.
Okay, so Alan, I know the question that's on everyone's mind right now is what can you do to minimize estate taxes?
Well, we're coming to that. And by the way, you can't just give away the asset. It sounds easy. Yeah, a few $1,000s here or there, nobody's going to, maybe catch on to that. But there's a gift tax. So if you think your $10 million estate, you can just shuffle it off to the kids at the last minute, you can. Nothing prevents you from doing it, but you'll find that you'll have what amounts to a gift tax equal to pretty much what the estate tax would have been. So gifts by themselves can be good, but can be bad. What can you do to minimize some estate taxes? Well, number one, I think the most important and easiest thing to do is in your will, create a bypass trust. We touched on it before. Take a $10 million estate. Instead of leaving the whole thing to my wife, if I had a bypass trust in the will, and by putting a trust in the will, all I'm doing is putting language in the will. Nothing's activated. I'm not opening up a trust yet. I could change it because I could change the will. But if I die, then it activates. And what it'll say is, oh, instead of giving my wife, I'll make this up, $10 million, let's give her $5 million, and we'll put $5 million in this bypass trust. She'll have access to that bypass trust funds. She'll probably even be a co-trustee of that trust. If she needs principal out of there, there'll be